A warm welcome to the Risk Reversal podcast on this Wednesday, June 4th, midweek of the first week of June. Dan Nathan, how are you?
I'm doing well. As you like to say, it's hump day, guy. And there's still...
No, I don't
you don't say
that.
There's still... I got you on Fast Money last night. I mean, the face that we got. And then Mel kind of laid right into it. I said, this guy likes to say climbing a wall of... Oh, no.
Climbing a wall
No.
of worry.
It was cash on the sideline.
Cash on the sidelines.
Yeah.
All the things that just irritate me. And by the way, it's not just me.
Correct.
Apparently, it irritates a lot of people. Doug Cass sent us some...
yes.
correspondence recently about that.
Pretty good stuff. Okay, let's just hit the news here a little bit, guy, because there's obviously it's just trade, and it's tariffs, and who's going to come to the table, who's not going to come to the table, how long it's going to take to do, 170 bilateral deals, who's pushing back, all that sort of stuff. So again, there's a bunch of stuff like that. There was a couple interesting articles in the Journal talking about how the Chinese are going about this and what are some of the angles and the leverage that they might have on us. Elon Musk doesn't like the big, beautiful bill at all. I mean, he's out of the White House for a couple days, a little war of words there. We'll talk about how, some of the Republicans are getting a bit more, what do you say, emboldened about some of the things that they think are most important. That's obviously in the Senate. And then non-farm payrolls, the all-important jobs report Friday morning, the little ADP stuff. Where do you want to start?
Yeah, well, I find it fascinating that there's still people out there that are elected officials that have a hard time understanding the difference between the deficit and the debt of this country, and they conflate the two seemingly on a never-ending basis. And I guess for the sake of this podcast, it's not all that important. But what Elon Musk was concerned about was this bill will just continue to add to a debt that I think, and a lot of people think, it's not just me, is getting a bit out of control. And it's not just necessarily the number, because quite frankly, if we had a GDP that was somewhat commensurate with the debt, you'd be okay with it. But it's just the ratio of debt to GDP that I think people should be worried about. And there's this belief that you can grow your way out of it, and this bill will help spur growth. And listen, I'm not an economist. I don't know. There's the other side of the coin that says it's just going to add another, $4.5 trillion over the next however many years to a debt that's already ballooned to a level that I think is unsustainable. So, you say what you want about Elon Musk. On this front, I think he makes some salient points. And to your point, I think there are some people on the Republican side of the aisle that are somewhat frustrated with this as well. Some of the spending hawks that just think this entire thing's gotten a bit out of control, which is the primary reason that I think yields are going to continue to go higher.
Right. And so part of this problem is for these deficit hawks is like, where do the cuts come from, right? If you're going to do this big bill, if you're going to cut basically taxes over the next 10 years, $4.5 trillion, they wanted to see cuts of $4.5 trillion. If you cut anything that's going to make an impact to that, it's healthcare and it's defense. I mean, like, that's just that simple. And your concern and many other people's concerns is that the debt service is going to be the largest line item, right?
For the U.S. government.
Yeah. And so it's just a really tough place to be, which leads us to, resetting the scales, if you will, on trade, right? These things are supposed to kind of go hand in hand if you think about it. And on the trade front, it's just, goes back and forth between who has the leverage. How have we gone about doing this? What are the goals, right, of doing this? And we can all agree that, leveling the playing field with certain countries, specifically those of our adversaries, right, who you and I have talked about this, I know a lot of folks much smarter than us, is like the idea of getting ripped off is just not something that makes a whole heck of a lot of sense to reorient global trade, right? Because we realize why certain countries have deficits with us, right? And so, we like to buy more shit. It's just that simple. And then countries like, China, they have massive savings rates. They are not nearly the consumers that we are. They live on a much lower, existence as it relates to incomes and the like. They also have a centrally planned economy. Like, it's just really complicated sort of stuff. But when you think about how the Chinese are hitting back, and Trump overnight, I think he tweeted out something that, it's going to be much harder to do a deal with the Chinese. I think that's a really interesting comment from a guy who basically became popular by, at least in our country, by the art of the deal, right? This is a guy who said on the campaign trail, I'll cut a deal really quickly, whether it's a war in Ukraine Ukraine, whether it's trade, all that sort of stuff. And here we are now, 150 or 130 days into the administration, and it doesn't look like this is going to happen anytime soon. They had a 90-day reprieve. We're going to get to 90 days in the not so distant future. We're not going to have a deal. And you tell me what that does for CapEx and R&D spending and jobs and, all that sort of stuff here. We're already seized up a little bit. It probably gets worse over the course of the summer, Guy.
Well, you know what I think about on the job front, and I think the CapEx, you make a good point. And I don't think CapEx is etched in stone for a lot of these companies. We've used the word sanctity around CapEx. I mean, I think companies are allowed to sort of change their mind. So we know what the numbers that have been talked about, it's still going to be something to watch if it comes to fruition. But the point you made about getting ripped off, and I've made this point and I stand by it. It's hard to say that we, the United States, are getting ripped off in a meaningful way when, again, I've said this, we're less than 5% of the global population. We're about 30% of global GDP. So those numbers suggest that, maybe taken advantage of around the edges. But, a lot of the deals that have been out there and a lot of the reasons that we have these deficits with these countries are for the reasons you stated. We just buy more of their stuff than they buy of ours, which by definition doesn't mean we're getting ripped off. Again, taking advantage of here and there, yeah, probably. But when you enjoy those kinds of numbers, when you're sitting in that kind of pole position, it's just hard for me to sort of come to the rationalization that, we're getting ripped off in a meaningful way.
Yeah, let's go back to a little bit with China, because I think this is, kind of the most important, obviously, negotiation as relates to trade. And this is the one that you think would be most focused on as a country, given their adversary sort of status relative to Canada, Mexico, and the EU. So Trump, put those huge reciprocal tariffs. This was on April 2nd, April 3rd, whatever it was. Market careens lower, treasuries get sold, dollar gets sold, becomes very clear to them that this is not a great way to go about this. They pull most of the reciprocal tariffs. They give a 90-day window to negotiate. Trump right now is pushing very hard and he called that a win, by the way. He's pushing very hard for a call with President Xi. It looks like that might be elusive, or maybe they get to the end of this week. He'll obviously get off the phone, tweet something that it was a big success, right? And that's the sort of thing that, he's looking to kind of set the stage for as we get closer to that 90 days. But then that tweet last night, very tough and extremely hard to make a deal with. What do you think that is setting for expectations as we kind of get into, the end of this quarter? And, things got off to a pretty rocky start with this whole rollout of tariffs. It seems like, it's not going away anytime soon. What sort of expectations do you think he's trying to set?
Well, there'd be people that say, and I can understand they would say this, when he tweets something like, it's going to be very tough for them to make a deal. What he's setting up for is effectively a deal. And, his ability to then say, I thought it was going to be really tough, but we came to this beautiful deal. So I'm sure there are people out there that think it's just posturing ahead, basically under promising, over delivering type of thing. So there's that. I mean, but the flip side of that coin is, and you've said it, and a lot of people have said it, these deals take a lot longer than just a few weeks or a few months. I mean, they typically take, many months, if not longer than that historically. But maybe things have been sped up. Who knows? Maybe it's in both sides' best interest to hammer something out. I'm really not sure. I'll say this, though, as well. As much as the market has rallied on the hopes of trade deals, some of the underlying things that we have talked about have not gone away. And we're going to get a jobs number. We've talked about that. I still think this is a market that has gotten itself, as we're sitting here, almost around 6,000 in the S&P, expensive once again. All that negativity in early April is turned into unabated optimism. So that pendulum has swung very quickly, very far in a very short amount of time.
Yeah, and I think that's one of the reasons why that non-farm payrolls number is kind of important, just to kind of get a sense for the direction of hiring. I know a lot of folks think that Peter Bookvar in particular over at Bleakley, who writes the book report, he thinks that it's clearly moderating, at least, the jobs growth, that sort of thing. Just the last thing on trade, and we'll move on for a second, is like, this kind of tit for tat. I mean, both sides are basically claiming that they're, not living up to, let's say that, slight little framework. And you got to go back to the first administration. I mean, they put the first tariffs on China in 2018. They really didn't have a framework of a phase one deal until January of 2020. So I think the likelihood that we've made a lot of progress in the way in which we negotiate. Now, it comes down to leverage. And you saw the headline overnight that the Chinese are considering buying, 100 plus or hundreds of Airbuses. Now, obviously, that will take a decade or more to deliver those sorts of planes, and that would be at the expense of Boeing. This is the sort of leverage a company or a country like that has with a country like ours, because if you're talking about deficits or surpluses as it relates to trade, that's a big lever to pull, right? And then if you think about Apple, you think about Tesla, you think about some of these other large U.S. manufacturers, NVIDIA, who have big stakes in China, this is stuff that's still kind of up in the air. So I would not expect, listen, I'm not an expert in any of this stuff either, but I would not expect, any sort of deal anytime soon. One last thing, guy, steel. Okay, we get most of our steel that we import from our allies. That's Mexico, that's Canada. Let's say the two of them are about $33 billion a year. You just raised the tariff on steel from 25% to 50%. That went into effect overnight at midnight. Now think about this. If you are in construction, if you are in manufacturing, if you are in the auto business and you use a lot of steel and you rely on steel that is basically imported, and all of a sudden, let's just say cumulatively that's $33 billion, you all of a sudden have a $16 billion tax on the steel that you are bringing in to manufacture. And then what do? You either eat that or you try to pass through a bunch of it through to the end user, right? So this is one of the things, and just you buttoning this up with inflation and expectations. We talked a little bit yesterday about the OECD. This is this, organization out of Paris that lowered the growth rate, higher inflation expectations. We're talking about stagflation. So I don't think we're that much further along than we were 2.5 months ago as we were thinking about this whole setup.
No, I don't think so either. And I'm probably one of the few people that still think inflation is a problem, despite the fact that things are trending the right way. I mean, we are nowhere near where we should be at this point. If you think about it, if you go back many years when, this is not me saying it, the Fed used the term transitory to talk about inflation. Well, they got that wrong. And, it's still a problem, and it's a problem for a lot of people. And look, there are people that think tariffs actually are deflationary. I can understand that. Brian Sullivan tweets about it to the extent that people follow him. There are other people that think it's very inflationary. If it kills demand, if price, that is obviously deflationary. I don't know if that's the end goal or not. I think, though, that the increased price of goods by definition is inflationary, especially goods that people need, that are staples, that as much as you don't want to necessarily have to buy them, you have to buy them. And we'll see how it plays out. That's why I think the Fed's sort of standing pat here, despite some of the pressures from the administration and other external forces, by the way. There are a lot of other people out there with their self-interest for having yields lower. But, I think they stand pat. Now, at some point, they're going to have to make a move. And yes, they'll probably be late, but this is just my opinion. I think better late in this situation than early.
Back to the markets for a second. You just mentioned, we're basically within, a whisper or whisker, either one, whatever you like to use here, of those prior all-time highs from, mid-February. 6150 was the number. Here we are, like to your point, we're just around 6,000. The S&P's up nearly 2% of the year. The Nasdaq's up nearly 3% of the year. But what really sticks out to me, Guy, is the 10-year yield, which you just mentioned at 4.44. Okay, like really hasn't budged a whole heck of a lot. I think at the lows in the stock market in April, I think we were at 4.6% in the 10-year. We also have a U.S. dollar that is just stuck here in and around 99. This is the U.S. dollar index. So two of the three that we were most focused on, risk assets, if you will, in the throes of that sell-off of the equity market, are still kind of stuck, in and around where they were then, which leads me to believe there's a massive disconnect, at least in the way investors are thinking about risk right here as it relates to the stock market. Now, I'll take it one step further as far as stocks are concerned. The Russell 2000 small caps are still down about 6% on the year, well below their all-time highs. This is a group of stocks or a group of companies that are going to have a much more difficult time if we do have a protracted sort of trade war, if we do have stagflation, where, so that's something I think to keep an eye on. And I don't think you and I are going back and forth on this saying that we're about to have a calamity here as it relates to the stock market if we do not have any substantial trade deals anytime soon. But the longer we don't have trade deals, the longer that we've imposed these sorts of 10% across the board, it will weigh on global growth. And it's likely to be harder here than it is in other parts of the world, at least in the intermediate term.
So what you just talked about should make yields go lower, but they're not. Now, you can sort of think about this intuitively and say, if the economy wasn't as weak as it is, and if some of these soft and hard data wasn't as weak as they are, you'd see yields significantly higher. So oddly enough, the only thing keeping rates at bay is the weakening of the economy, which is not exactly what they want, but I think they're looking for lower rates, regardless of how we get there. But I'll continue to say, as soft as things I think are, the offset of that I think is more important, and more important meaning the fact that you just said people are sort of shying away from our assets, be it our equities, our currency, or our bond market. And, the fact that, again, this debt is such a problem. And you see people like Jamie Dimon last week talking about a crack in the bond market. And I think he said something like, it's going to happen. I'm telling you it's going to happen. I think that's pretty much verbatim what he said. When the most important banker in the world says something like that, it's not necessarily self-serving. I think they're set up for it, but I also think he believes it. And so you don't have to listen to me when a guy like Jamie Dimon says it, and then we've talked about it. Steve Cohen says similar things. Dan Druckenmiller says similar things. Paul Tudor Jones. There's a real laundry list of people high up on the totem pole in terms of intellect and market acumen. And then you throw sort of a David Einhorn in there as well, who has been a gold bull for a long time for the same reasons we're talking about. It makes you sort of scratch your head with an S&P of 6,000, seemingly impervious to all of it.
Yeah, last night on Fast Money, we had a gentleman named Drew McKnight. He's a co-CEO of Fortress. These are, a very big player in the private credit market. And we were talking about the state of private credit. This is an industry or a group, I don't know what you call it, within, the capital markets, which have been lending, outside the traditional banking system. They basically have, they borrow from the big banks, right? And then they lend to, in an unregulated fashion, for the most part, to, lots of different companies here. And so generally, these companies were able to, borrow directly from, let's say, a JP Morgan or Bank of America. They might do that, but they're getting better terms in the private sort of market here. And so, you asked the question relative to what Jamie Dimon said, really about the treasury market, right? And the answer that we keep hearing about private credit, it's like, it's a safe credit, they keep going on and on about this, but it's very opaque, right? And so if you think about something breaking in the treasury market, there's going to be a ton of knock-on effects as it relates to other parts of the credit markets. And that's just one, I think, that every week, there was an article in the FT yesterday or 2 days ago. There was an article in Bloomberg 2 weeks ago. There was an article in Wall Street Journal talking about this pocket of risk that you really can't put your finger on. And it is levered, and there's multiple touch points as you think about it through the financial system. So that's one that, I think a lot of these folks keep tamping down what they think the potential risks are there, but this is something that, like some of the traditional regulators who are meant to keep an eye on this sort of stuff, who actually have not done a great job, if you think about it, over the last 20 years or so, maybe they're underappreciating a pocket of risk there. Does that make some sense to you?
It makes a lot of sense. I think the market clearly is. I do think there are people out there that understand that those risks are sort of hanging out there like this sort of Damocles, but I also think there's an investment community that sort of says, damn the torpedoes, full speed ahead. Until it manifests itself, there's no reason to be worried about it. And if it does happen, we'll be able to sort of pivot. And maybe that's the right strategy. Who am I to say at this point? Because, when you watch the market sort of levitate seemingly on a daily basis, it gives a lot of creed to those people that believe exactly that. But, the concerns, again, all the concerns that I've had have not changed. Some of them actually have gotten worse. The only thing that's changed is the fact that over the course of the last, month or so, I guess it's longer than a month, since early April, when we traded down to what, 40, where did we get down in the S&P? Down
4850.
like
4850.
4850.
Yeah.
I mean, think about that. It's more than 1,000 S&P points in, let's call it 2 months now, which is extraordinary. And in the face of, all the things that we've talked about, with nothing really significantly different on the trade front other than these respites that have been announced. So it's a really hard thing to sort of, at this point, it's a really hard thing to handicap, in my opinion.
Right. And your respite means the taco trade, right? So, he always chickens out, that sort of thing. And I think that is, it's interesting that an acronym was formed for that because, folks like you, me, whether they're pundits, whether they're investors, whether they're strategists, I mean, everyone was talking about that sort of cadence, right, with this sort of stuff. And I think, I guess, what that leads people to believe is that the worst case scenarios are kind of off the table. We're not going to see threats of 145% reciprocal tariffs anymore. And that was at the throes, of that April sell-off. That's what folks were like saying. How much does this sort of get ratcheted up? I just want to hit two things. I know we got to get out of here, Guy. So CrowdStrike, security name. This is one of those ones that could do no wrong. It was just trading at all-time highs, headed into their print last night. The headline is that CrowdStrike plunges after disappointing, guidance or whatever. Down 7% after this thing has been an absolute monster. One of the first stocks on my board that made a new all-time high since those April lows. The problem with the name is probably not as much their fundamentals, right? Going forward, it's probably expectations and then valuation. It's trading at 24 times sales, 140 times earnings, that sort of thing.
Yeah, we talked about it on Fast Money last night. The fact that when you're trading it, I think it's 100, whatever it is, call it 110 times next year's number. Maybe it's more, but it's north of 100. You have to really crush, not only in terms of the quarter, but in terms of the guidance. And they didn't do it. But with that said, I mean, the stock to me actually is hanging in there pretty well. We're trading about 455, and I said it last night, and I'll say it here. All we've done is got back to that prior all-time high that we made back in February before the stock sold off. So this should be the first level of support. And this is a pretty amazing story. The whole cybersecurity space, to me, continues to be a story worth watching. Now, valuation is obviously a concern, but the fact that this stock, to me, Dan, this is just me, is not more down, it's down 7%, but not down double digits, I think is somewhat encouraging. I think.
Yeah, no doubt. And then here's one, and this is a name, and we talk about upgrades, downgrades, analyst ratings or whatever, not particularly important, but to me, it's kind of interesting from a sentiment standpoint. Apple's downgraded by an analyst at Needham. I don't know this Needham. I don't know this analyst. I don't know if they're any good at it. All I know is that the stock's up 1% on a downgrade. They're moving to the side, they say. They're lowering their price target. They think the stock could trade 170, 180. The stock's at 205. What was the all-time high that it made a few months ago? It was probably
I want to say it was 260 and change.
Okay. So this is one of the kind of worst performing Mag 7 names, specifically off of the lows, the rally back, and it's still down about 18% or so from on the year, which I think is worth noting. Microsoft and Nvidia have a greater market cap right now, and the only thing I'll say about this is this company has never had this few buy ratings as a percentage of all the analysts who cover the stock. It's about 58% or so of the analysts rate the stock a buy. If you look at the rest of the Mag 7, ex Tesla, most of them have above 80% of the analysts who cover it as a buy. No sells on most of them, that sort of thing. So I just think it's an interesting contrast. They're talking about Apple Intelligence. I mean, you and I, we get a lot of things wrong. Okay, you admit it more than I do. Okay, I think you're probably much more tougher on yourself than you probably deserve to be. But man, oh man, when Apple Intelligence was launched a year ago, right? We know WWDC, I think it starts on Monday or so. It just looked obvious to me at least, who gets every iPhone and every iOS upgrade. I know you're probably on iPhone 6.5 or something like that. There was no there. And the fact that the analyst community or investors were so quick to get excited about something that they really felt was they were behind the eight ball. Well, look here where we are year on year, and nothing is likely to come out when they were, have this event next week. And really the issue is an upgrade cycle that's not coming until they have something material. I think there's a real problem here. So, that's just Apple. One downgrade doesn't really matter. Thoughts really quickly headed into WWDC.
But it doesn't matter. But I think their points are well taken. And, I said it with you on the show that night a year ago that it didn't seem like a big deal to me. And by the way, the few hours in the aftermath, the market didn't really care all that much. And then in the ensuing weeks, obviously it got excited. Gene Munster, by the way, was very excited that day, and he proved to be correct. And the stock went from 170-ish to, I said, 260, not in a straight line, but over the course of a couple months. The fact that it retraced that entire move in early April, something that we thought would happen, I think was worth noting. We've obviously bounced, but not nearly to the extent that some of the other stocks have bounced. So I don't think it's completely unreasonable to think you trade back down to those levels that you saw this time last year, which is sort of between 165 and 170. And then at least valuation is, I think, a little more reasonable, although probably at that level still somewhat expensive.
Yeah, no doubt. All right, so we're looking forward to Friday morning, the all-important non-farm payroll number for May. This is going to be an interesting month, guy. We get CPI on June 11th. We have a Fed meeting on June 18th. We have quarter end, obviously, at the end of the month. Earnings are pretty much done for the most part here. So it'll be interesting to see how trade, tariffs, tax, and then Fed, that's really going to dominate, I think, into the end of the quarter. So we'll see if we get that sort of mark over the balance of this month, because investors don't seem particularly worried about what's going on right now on all those fronts, at least if you're looking at the stock market. We highlighted the fact that the dollar and the 10-year yield are still a problem. So you and I are probably going to be more focused on those two than we are on the VIX and what the stock market's doing. But the more complacency we have, the greater the likelihood we have is like just tape bombs taking the markets down a little bit. So Danny Moses drops on the pod Friday morning with you and me. We're excited to have him back. He is the host of the On the Tape podcast. Tomorrow morning, we have Deirdre Bosa of CNBC Tech Check fame, and we're going to go through a bunch of the stuff in generative AI and the like here. And you and I, we got market call today at 11. We got a market call tomorrow at 11, and that's about it.
Weeks are busy, baby, but I appreciate everybody staying with us. Back from market call. Stay tuned and continue to check out the Risk Reversal Media YouTube page. Lots of good things going on, Dan.
A ton of things. All right, we'll see you later. Thanks.